Video 4 of chapter 4. I think this is going to be the last one. At least I hope it is. We're going to look at one more journal entry problem. If I have any more, they'll be supplemental. But what I mean is the last video for the outline or the lecture notes for chapter 4 solutions. So we're going to look at one more problem. This is a really cool problem because we're going to look at both we're going to be looking at the buyer and the seller. So in this buyer and seller that we're looking at, it'll be Sydney and it'll be Troy. So anyway, enough said. I want you to read the problem and then pause the video, read the problem, and come back. Okay. So you've read the problem, and let's work Sydney first. Let's do the buying for Sydney, and then we'll come back and we'll look at the transactions for seller. So the cool thing about this problem is we have the same problem, and we can do it for both the buyer and the seller. So this really gives us a good indication of what do you do if you're the buyer? What do you do if you're the seller? And if you know this problem, I think you're going to be well on your way to mastering the concepts that we need to learn in chapter 4. So let's go on. So on May 11th, according to the problem, the company bought $40,000 worth of merchandising inventory, and they financed it all accounts payable, okay? Then on the 12th, they returned accounts payable, returned $1,400 in merchandising inventory. So again, anytime we return, anytime we have an allowance, the entry is always the same. It's debit accounts payable, credit merchandise inventory. They gave us the dollar amount. It was $1,400. Finally, for the buyer, on the 20th, they paid their accounts payable in full within the discount period. So we debit accounts payable $38,600, and we credit merchandising inventory for the discount $1,150, and for the difference cash $37,442. Now, I feel like at this point we've gone over so many discounts that I don't need to go over it again, except I wanted to do one thing. Don't forget that the original accounts payable was $40,000. Then they returned $1,050. No, $1,400. I was looking at that and I was like, no, I just did that, and I could have sworn it was $1,400. And my computer's super happy with me today. It wouldn't let me erase. So then we have what, 38.6 is the payable, and then the discount's 3%. So let's go real fast down here and look at that again. So the accounts payable is 38.6, not 14,000, because of the return. Okay, figured out what it was, y'all. I moved my computer closer to me so I could write on the screen, and battery was running low. I was wondering why I wasn't being so happy. All right, so, and then we take 38.6 times 3%, and we get 11.58 for the discount. And again, I think you guys are good enough to finish up that from this perspective. The neat thing is we're going to look at the seller, okay? Because we've done the problem with the buyer several times. We haven't really done one with the seller. So let's look on May 11th. Instead of recording this entry that we have here for the seller, we have this entry to record the actually we have these entries. Let's be clear on that. We have two entries. And it looks like I'm not in the screen. Let me slide that over. Yeah, there you go. That should be better for you. So there's two entries. The first entry is to record the sale, the sale. So they sold it for $40,000. So the seller will debit accounts receivable and credit sales, not net sales. Remember, that's a completely different transaction that occurs at the end of the accounting period when you consider sales discounts, returns, and allowances. So debit accounts receivable, credit sales. They also must get rid of this merchandise inventory. They don't have it anymore. The merchandise inventory is now at the buyer, or is still in transit in the hands of the common carrier, depending on the shipping method. But whatever, they no longer have the merchandise. It needs to be recorded as a reduction, a credit to merchandise inventory to reduce that inventory amount. And then also they need to record the cost of goods sold to reflect that that merchandise has been sold and now needs to be not on the balance sheet where inventory is, but on the income statement where cost of goods sold is recorded. So those are the two entries that will be recorded on the day of sale, compared to just the one for the buyer. So the seller has two entries when we sell it. The buyer has one entry to record that they bought it. Okay? Now, if there's two entries here when they sell inventory, there is also two entries when they record the return of merchandise. So they will debit sales, returns, and allowances. And I didn't type it all out. I can do it right there with my pen. I'll just add it. Sales, return, and allowances. They debit that and they credit accounts receivable. Okay? And they do that for the gross amount, the $1,400. But their inventory cost for the $1,400 worth of sold inventory is $1,050. So the entry is record an increase in merchandise inventory with a debit and record a reduction in cost of goods sold with a credit. It's the exact opposite of this. It's the exact opposite of that. And this entry, let me clean this up. I got too much going on here. So, and then this entry, accounts receivable sales, is the same as this one, except we don't want to put it back in sales. We want to put it back in sales, returns, and allowances. Okay? And then to record the payment of the buyer's accounts payable on the 20th, the seller debits cash for $37.42. And let me just, I got to draw an arrow. See there? They paid the cash, they got the cash, right? That's pretty cool. You got to admit, seeing these side by side, I think is pretty cool. Sales discount for the buyer, and it's not a sales discount for the, I'm sorry, I said that backwards. Sales discount for the seller is a reduction in inventory costs for the buyer. They don't put sales discount. The buyer does not put sales discount. The seller only has the sales discount. All right, so again, let's just review real fast. I want to make sure we circle around and close the loop, if you will. Where was that at? Yeah, right here. Sales minus sales discounts minus sales returns and allowances. This is for the seller. Because the buyer doesn't record sales discounts and sales returns and allowances or sales. Okay, so they all go together. So that's the seller. Let's get back to where we were. All right, so again, they debit cash, credit sales discount, and then credit debit cash, debit sales discounts, and credit accounts receivable for $38,600. See, they no longer have an amount of accounts receivable owed to them for $38,600. It's been paid. They didn't pay $38,600. They paid $37,442 because the buyer said, if you get us the money early, we'll give you a 3% discount of $11.58. Okay? Now let's just completely close the loop and make sure we understand. This is for the seller. They record sales of $40,000. They record the return of $1,400. all this is in sales dollars, okay? None of this is in inventory dollars, okay? Then we record the discount that was taken. That gives us net sales, not gross sales, net sales, 37,442. Then we record the cost of goods sold of 30,000. You know, and I made a boo-boo when I did this. I forgot about the return. So that cost of goods sold, so if you happen to have printed one out before I made that change, then my bad. I thought I checked my work, and I guess I didn't. 28,950, and I'm pretty sure I got this from the solutions in the book. So they have a typo there. So then the net income is 8,492. Actually, then there there's only one return. I was fixing to say, was there anything else? That's it. All right, so I got that right. So 30,000 minus 1050. I always check my work, and I'm doing it live, so yep, good. All right, so y'all saw that I made a mistake. I mean, it's easy to do. All right, we have these are computerized now, y'all, so it's not as likely to have a mathematical error like that. All right, so because when you post a return, it automatically updates cost of goods sold for you. Anyway, so cost of goods sold is not 30,000. It is less. So let me just show you again, because I feel rotten. Cost of goods sold was 30,000 originally on the sale, right? Up here when they originally sold. But they had a return of inventory, the cost of goods sold of 1,050, resulting in cost of goods sold of 950. Okay, and then that means the gross profit is 84.92. You see the error that I had with the gross profit being understated, overstated. It was originally 30,000, and it was supposed to be correct at 28,950. Basically overstated cost of goods sold, and by overstating cost of goods sold, it made the gross profit lower than it really should have been. So anyway, I think it was a good mistake, good teaching moment. All right, so this is the last video I have on the Chapter 4 Solutions handout. If you have any questions, always email me. We can do something to help you get through the rough patch. Practice, practice, practice. And as always I say, you got to know why you did what you did. All right, so if you get the right answer, great, but make sure you know why you did what you did to get that correct answer before you can say you're successfully ready to take the test. So keep plugging away until you get there. If you need me, email me.